Are you ready for the financial roller coaster ahead? The investing landscape is shifting, and it's not as straightforward as it used to be. If you're wondering where to park your money for the long haul, you're not alone. A year or two ago, the answer was simple. Buy, buy, buy. But now, things have changed dramatically. The market has rebounded with vigor, and those once-in-a-lifetime bargains are harder to find. So, what should you do next? Let's dive into some key considerations that could shape your strategy moving forward. First, let's talk about bond yields. They're sounding alarm bells for some analysts. Governments in major economies like Japan, the UK, and the USA are drowning in debt. And every upward move in yields sparks concerns about sustainability. This isn't a new issue, but it's one that's likely to stick around for years. Here's the tricky part. No one can predict when a potential debt crisis might strike. For instance, last August, Japan briefly rattled global markets, including Australia's ASX, causing a fleeting panic. Looking back, that dip turned out to be an excellent opportunity to scoop up stocks on the cheap and ride the wave until now. Fast forward to today, and the situation feels different. The ASX might be down slightly, but it's holding steady without any signs of widespread panic. Gold shares, meanwhile, are shining brightly, offering a reliable hedge against uncertainty. If you're playing the medium to long game, there may not be much action required right now other than staying informed and keeping an eye on developments. But here's where it gets controversial. Where should you invest for the future? It's not as clear-cut as it was 12 to 24 months ago. Back then, I was enthusiastically urging investors to jump in. Today, however, the market is fully reflated and the easy opportunities are gone. And then there's the elephant in the room, artificial intelligence, AI. Its rapid advancement poses both risks and rewards for various sectors, especially the job market. What does this mean for your portfolio? I believe we're heading toward a significant divergence in how markets treat AI winners versus losers. Companies catering to middle-class consumers may see their customer bases shrink as automation takes hold. On the flip side, certain industries seem better positioned to weather the AI storm. Take resources, for example. Minerals buried deep underground can't simply be disrupted by technology. They either exist or they don't, and extracting them is either profitable or not. While AI will inevitably streamline mining operations, making companies more efficient and potentially more profitable, there's another layer to consider. As a shareholder in resource companies, you own a stake in something tangible, actual assets in a world increasingly dominated by digital promises. That said, there's always a catch. Governments, strapped for cash, might try to claim a larger slice of the pie once their financial troubles become unbearable. Remember how Queensland swooped in to grab coal profits during the boom years? It's a risk inherent to commodities. But it becomes even more pronounced as Western economies struggle under mounting debt. Now, let's zoom in on two specific resources, coal and lithium. Both are navigating the downside of their cycles, but there are glimmers of hope. Lithium appears to be emerging from its slump, while coal lags slightly behind. Yet the undeniable truth is that the world still needs energy, and lots of it. Coal remains indispensable, at least for now. Demand alone makes a compelling case for both sectors, especially since neither faces significant supply increases anytime soon. What's more, resources are taking on strategic importance in ways that weren't fully appreciated over the past decade. Consider why Donald Trump expressed interest in Greenland or why China maintains tight control over rare earth elements. Resources equal power, plain and simple. Speaking of power, here's something intriguing. There's a tiny Australian stock that could play a pivotal role in bolstering NATO and allied nations' defenses in the event of a major conflict. This makes it a potentially lucrative opportunity for savvy investors in the coming months. Curious to learn more? Check out the full story here, https://pro.fattail.com.au/m244941. For Australia and its investors, this is fantastic news. We're sitting on a treasure trove of resources across multiple sectors. Over the next few years, my personal focus will be squarely on resources. Why? Because the lack of substantial investment in this space over the past decade sets the stage for a looming demand crunch.
I say this with confidence because, throughout my 14 years at Fat Tail, resource investment was perpetually pushed to the sidelines. Year after year, I watched as opportunities were delayed, or worse, ignored altogether. It's astonishing how quickly those 14 years flew by. Now, the future is knocking, and resources are poised to make a big splash. Before we wrap up, let's touch on a critical chart shared by Murray Dawes. It highlights the relentless climb in 30-year bond yields worldwide, signaling a fragile phase. Since Japan abandoned its yield curve control policy a year and a half ago, long-term bonds in Japan, the UK, and France have been searching for equilibrium. Rising yields in countries with shaky fiscal foundations create a vicious cycle. Higher rates worsen economic prospects, which in turn push yields even higher. Consider this. The Bank of Japan owns half of all outstanding Japanese government bonds. Imagine the mark-to-market losses they're facing as yields surge. Ouch.
Life insurers in Japan aren't faring much better, with paper losses quadrupling over the past year. Meanwhile, the prospect of U.S. bonds being sold to cover shortfalls looms large. Is it possible that the end of Japan's yield curve control is influencing bond curves globally? While stocks have remained relatively unfazed so far, cracks are beginning to show. Commentators are starting to connect the dots between rising yields and recent market weakness. The spike in gold and silver prices hints at growing unease. Could we be on the verge of a front-page crisis? Only time will tell. So what's your take? Do you agree that resources are the next big opportunity? Or do you think AI-driven disruption will reshape industries faster than expected? Share your thoughts in the comments below. I'd love to hear your perspective.